All right, we're joined now by an esteemed guest that has been a friend of Squawk for a while. Nouriel Roubini is with the NYU Stern School of Business, professor and chairman of RGMonitor.com. Hey, Nouriel, last time you were on, we were going to call you Dr. Doom, and you said, don't call me Dr. Doom. I am not a perma-bear, and you seem like you got a little bit less negative. After reading what you're talking about now, can we call you Dr. Doom again?
Well, I've always been Dr. Realist. The important thing is to get things right. It's clear that this global recession, the worst in the last 60 years, is coming to an end. But now the main question is the shape of the recovery. The market and the consensus believe it's going to be a V-shaped recovery with rapid return to potential growth. In my view, it's going to be more like a U-shaped recovery, anemic, subpar, below trend. That's also the view of the folks like Mohamed El-Arian at PIMCO, the view of the IMF. There are many reasons why this recovery is going to be anemic. First, the labor market is still awful in the U.S. and advanced economies. That's going to be drag on labor income and consumption. Two, the U.S. consumer is shopped out, saving less than burner. Has to save more, consume less. Therefore, with consumption 70% of GDP, growth is going to be anemic. Three, in the corporate sector, we have a glut of capacity. Utilization is 69%. Why would firm want to do lots of capex when there is a glut of capacity? In most V-shaped recovery, investment grows rapidly, not this time around. Four, the financial system is damaged. Banks and shadow banks. Credit growth is going to be limited, and that's going to mean we're not going to be able to finance residential investment, consumer durable, capex spending. Five, the fiscal stimulus is going to become a drag by next year, and if the fiscal stimulus continues, eventually large budget deficits that are monetized are going to lead eventually to crowding out of private spending. And finally, globally, overspending countries like the U.S. are spending less, while the oversaving countries like China, Germany, and Japan are not increasing their private domestic consumption to compensate for the falling U.S. demand. So globally, there is a glut of capacity, and the recovery of aggregate demand is going to be weaker. That's why the recovery is going to be anemic.
That's all you've got? That's it? It seems like a pretty thin argument. I'm kidding, Nouriel.
That sounds like Nouriel, that sounds like an L. That doesn't sound like a U.
No, it's not an L because we have the monetary and the fiscal stimulus. We've had the backstopping of the financial system. Emerging markets do not have the same kind of financial vulnerabilities like high leverage ratio of households and the financial system as the U.S. and advanced economies. Those emerging market economies can grow at a robust rate, but even their growth rate is going to be limited by the fact if there is not a recovery of the U.S., countries like China, Asia, and other emerging markets have been using the United States as the source of their exports. They have a model of export-led growth, and they have to switch demand from net exports to domestic private demand. So I do believe there's going to be a recovery, and I even believe there's going to be a risk of a double-dip recession. There's a low probability of a W, but if the recovery is anemic, if the stimulus goes away and private demand doesn't recover, and maybe oil prices go towards 100 because of this wall of liquidity chasing assets, there could be another double dip. It's not my main scenario, but there is a risk of that sort. But the main scenario is one of an anemic recovery. I don't understand how people can say this is going to be a rapid recovery to potential growth or above potential growth. I don't see the arguments for it.
Dr. Roubini, it's Bill Rudin in the studio.
Hi.
What would you recommend? You were in the IMF this weekend in Istanbul. What would you recommend to the policymakers to get the recovery to be more V-shaped and avoid the double dip? What would you be talking to Secretary Geithner and the President about doing?
Well, I was over the weekend in Istanbul and met many officials, and in my view, there is a difficult dilemma on the exit strategy, because if on one side you take away the monetary and fiscal stimulus too soon, you end up like Japan 98-2000 or the U.S. in 37-39, and you have a double dip. So taking the stimulus away right now when the recovery of private demand is still weak is a mistake that could be made. On the other side, if you maintain the stimulus, monetary and fiscal, and you have runaway budget deficits, and you keep on monetizing them, eventually that's going to lead to an unsustainability of fiscal policy, increase in expected inflation, and that could again crowd out the recovery and the recovery of private demand. And this wall of liquidity right now is chasing assets. Some of it is good news because it leads to higher stock prices. Some of it is dangerous because it has led to a sharp increase in oil, energy, food, and commodity prices.
Right.
There's going to be a negative shock on the commodity importing countries. That's why there are risks ahead in terms of policy.
Well, Secretary Geithner, I think, mentioned over the weekend that he would recommend to policymakers not to relive the past and put the brakes on too soon. So I think they understand the need to make sure that they do not impose higher interest rates too soon.
That's correct, but in other parts of the world things are different. For example, in the Eurozone, the ECB is hawkish about worrying about inflation and asset bubbles. They would like to exit soon, and they're worried, the Germans, the ECB, about large budget deficits. There are countries in Europe that have large deficits, large stocks of public debt, and banks that are too big to fail and too big to be saved. And therefore, the policy stimulus might be taken away too soon in places like the Eurozone or Japan. That's a risk.
Nouriel, do you wish you had factored in more of the liquidity back in March when the market looked so miserable?
Well, certainly this wall of liquidity has helped a lot the recovery of the markets. There are also fundamental factors. We avoided, because of the policy stimulus, the near depression. Therefore, asset prices should be higher. Whether it's going to be a V-shaped or a U-shaped recovery, there is light at the end of the tunnel. However the recovery is going to be, asset market are rising. And since we avoid Armageddon, risk aversion is lower, and investors are moving away from less risky assets like short-term treasuries to more risky assets like equities, like commodities, like credit, like emerging market asset classes. But my point is that while the economy has bottomed out and is barely recovering, since March the asset prices have gone through the roof. And unless there is going to be a V-shaped recovery that the market is expecting, if the flow of macro news is going to be worse than expected in the next few months, we saw the number, ISM, consumption, employment, durable goods orders, if the flow is going to be negative in the next few months, consistent with you, the markets have to correct. And if there's going to be a weaker recovery of revenues because of low growth and deflationary pressure, you cannot cut costs forever. You can cut the fat, eventually you're going to reach the bone and the meat, and you cannot do it anymore. And therefore, worse than expected top-line revenue growth, when you've done the cost cut, implies there are going to be surprises on the downside, also on the earnings side, and that could be a source of correction. Maybe Q4, maybe Q1. For now, the wall of liquidity is still chasing assets.
Okay, great, Nouriel. Thank you. We got it. We came too far, too fast for where the economic backdrop is. Good to see you today. Thanks for coming on.
Good seeing with you. Pleasure.
Okay. See you.